Hey everyone, we're back again with Alejandro Salcedo sharing his company analysis with me and you. And we're so grateful to be able to learn about Domino's Pizza, which I'm sure many of us have had Domino's before. And I'm just grateful that Alejandro is willing to share his insights into what he's learned because he's been doing a lot of extensive research. And I think that you and I will benefit from Alejandro's presentation. So with that, Alejandro, please take it away.
Hello, guys. Thank you so much. Domino's is a company very special for me because I've been in the restaurant industry for 8 years before working in where I'm now. So I have a big emotional connection to restaurants. So it's special for me to do this. So let's get started. So a little overview. It is the largest company in pizza company in the world with almost 20,000 locations in more than 90 markets. A lot of their business is carry out and delivery. 99% of their business is franchise. They've been growing the franchise part. Before it used to be less, but with time they are being focused more in franchise in every one of his restaurants. Obviously, they sell pizza. They also sell wings and other stuff, but most of their sales is through pizza. They make the dough for every store in the States in their company, and they just distribute it to all their franchisees. And their business segments is basically they charge royalties and they sell part of the food to their franchisees. So the big competitors are Pizza Hut, Papa John's, Little Caesar, and just regional pizzas. Pizza Hut used to be the number one, but with the change towards digital, they had very big restaurants and more people are eating pizza through delivery and carry out. So they lost the number one spot a couple of years ago. Here's some of the things I find really interesting in the franchise agreements. So the term is 10 years. That's how they start. They charge 5.5% of all the sales. In the US, 6% of the sales go to a national marketing fund that they use to just promote the brand through different segments. And they use international market master franchisees. So basically they do a business with a master franchisee and that person develops the market. Here are the largest international markets. Starts with India. I mean, they have almost 2,000 stores, United Kingdom, and they're growing. They're really, really big. The competitive advantages against other restaurants. I mean, they're really big, so scale. They have a big brand recognition around the world. They were one of the first restaurants that really invest heavy on technology, so they are ahead of a lot of companies in technology, so they're really, really efficient. And they're one of the only restaurants that has kept their fleet. I mean, they don't like to sell through third parties, obviously, because they want to control all the process. They want to control everything. There's a really cool story about the founder of Domino's Pizza. And is one day he was with an employee and one customer was dissatisfied and the employee basically didn't want to give the money back. So the founder took care of the situation and gave the money back to the customer and then sat down with this employee. And what he said to him is super interesting because he was like, we're going to lose $10 in this pizza. But if we don't do this in the long run, this guy might come once every 2 months and spend $10, and that guy might come during the next 10 years. And if you think about that, it's $2,600. So that's really interesting of how they adopt, like, treat their customers. Every time you lose a customer, you just think about that transaction, but in time is so costly if you don't do whatever you can in any business that you are to just be able to get that customer satisfied. So that culture really was ingrained at the start of Domino's. Here's the stores. The last 4 years, they grew almost 3,000 stores. I mean, that's crazy a lot, because that base of 17,000 stores is amazing. I mean, it's just crazy how big they are, and they just keep growing. They close a couple, but they just open. I mean, from 10 that they open, they just close one. So I mean, this is a pretty good average. So it's an amazing brand. A little of their income statement. Last 3 years been a little stable. As you can see, I mean, they keep growing in royalties, but their cost through inflation, and I mean, the fleet and the carrier is been making the gross profit less. But obviously, I mean, every business has gone through this. The debt. This is one of the things is super interesting about Domino's, is that they have a huge debt. As we saw before, they make 500 million a year on average, and they owe almost 5 billion. So basically, they will have to not spend in anything else if everything was stable. And it will be 10 years until they are able to pay this debt. So this is one of the things that is interesting, which I don't find that good, but obviously you as an investor need to value for yourself how you see this. I think what will Buffett like about what Buffett would like and not like about this company, I think they have a great return on tangible assets. For example, Dairy Queen is kind of what Domino's does, which is the franchise. In one of the shareholders meeting, they asked Buffett why he doesn't invest in McDonald's and why he did invest in Dairy Queen. And the reason is basic, is because McDonald's owns their stores, they own everything, and they do get a good return on capital. But Buffett likes capital light businesses. Domino's is a very, very capital light business. He likes the recurring revenue part, like the 10-year contract that you get with your franchisees. So they're gonna pay you a royalty during 10 years or more. They're gonna buy the food from you, so it's a very recurring revenue. They have a big brand advantage, which Buffett loves. I mean, he loves the brands. And they've been repurchasing shares for a long time, which, I mean, Buffett loves, obviously, if it's at the right price. And I think they've been doing it at the right price. But part of that is the reason they are so much in debt, because they've been repurchasing so many shares. But I think Buffett would not like the ratio of debt to net income, because again, like we said, it's 5 billion and they just make $500 million a year. So the lessons I learned is be careful with how much debt you have in any business you look into. I think Domino's has a big debt and is not that easy to pay, especially when they have to refinance. In the next couple of years, they have 2 times, they have to pay like $1 billion, which is the double of what they make in a year. So they're going to have to refinance at a very high rate, which obviously is not good. Then as I look into the franchising, especially from great names instead of starting from zero, we all like to start from zero and start our own business. But I think most of the time, if what you like instead of creating is making money, it's good to look into franchises. Domino's has a pretty cheap franchise for what they bring to the party. I mean, they have the best technology, they have the biggest brand. So instead of starting your own place, you can maybe open a Domino's if you like the restaurant business, and tie your business to recurring revenue, predictable revenue, which, like I said, having that 10-year contract, having the royalties, having that contract to sell the food to your franchisees, I think is an amazing business model. So that's what I learned from this wonderful company. Right to you, Michelle.
Well, thank you so much, Alejandro, for sharing these lessons and the overview. And like you said, that that long-term debt is a pretty big big thing that I understand they use some debt to buy back shares, but they probably also use some of the debt to do other things. Like I wonder if they used it to fund some innovation initiatives, because I know they have some of like their delivery fleet with the, you know, really high tech oven car, where you can keep the pizza hot, right? So they outdo the competition with some of their innovations. So I wonder how much of the debt went into, growth strategies, because that could be a good kind of debt, because even though it looks like a lot of debt, but it will pay off because maybe they will have more net income or better margins and profits in the future. Maybe it's worth it. So it makes me wonder, kind of if investors think it's a good kind of debt or kind of not such a good idea to have taken on so much debt. And other people, like some investors that I learned from, like Phil Town, he said that it would be ideal if a company can afford to pay off their long-term debt with at most 3 years worth of earnings. So if it's only $500 million a year, then this company would be in a more ideal place if it only had, say, $1.5 billion of long-term debt and not 10 billion. So in that way, it's a little bit concerning. But like you said, as an investor, you have to decide how big of a deal is that, and what is the debt being used for? Like if they're buying their stock back at the top of the stock market, that could be dangerous because you're getting into debt and maybe overpaying for your stock. I haven't looked into Domino stock, so I don't know if they're repurchasing at a good intrinsic value, or if the intrinsic value is mismatched. Like if I don't know if they're paying too much or if they're getting their stock at a good price. So hopefully they are. Do you know how much they were buying back their stock? About like how much compared to what the debt is being used for otherwise?
I think they've been well, they have been using a lot of their cash flow to buy shares. Obviously, when the price has come down, they buy more, and when it's been up, but they always buying. I just think they done it very, very quick. I mean, getting into debt, and they probably never thought that the interest rate were going to change so quickly. And now, again, like we said before, when they have to refinance, I mean, it's just going to be like higher interest payments. So I mean, I don't think that part is good. But as you say, I mean, is an amazing thing that, I mean, they're able to keep the Pizza Hut, and I think they also look into the self-driving cars that they can deliver to you, which if they are able to pull it off, I mean, it's going to be a great advantage. But I think they do have spent a lot of money in the buyback.
Oh, well, I hope it's in a way that, will be on the net beneficial for investors, right? Because Buffett thinks repurchasing shares is a good idea as long as you're doing it at an appropriate price. And also thought it's interesting that you're saying like franchising is a good idea. And I wonder how that compares with, like, say, other restaurant businesses that maybe don't franchise. Like I don't think Chipotle franchises, right? And
No, they.
yeah. Oh, sorry. No problem. So like I sort of wonder like how that compares. Like you're saying like franchising is maybe better than starting your own pizza business from scratch, right? But how have you looked into the benefits of franchising compared to, fully corporate owned stores like Chipotle or Starbucks?
Yeah, so I mean, as you said, Starbucks and Chipotle don't franchise. If if I went to the restaurant business again, I think my Domino's will be top of my head because the investment is like between 300,000 and 400,000, and you get like 130,000 out of it. So I mean, I think it's a pretty great return on invested capital. Basically, you get your money back between 3 and 4 years.
Okay.
And for example, McDonald's, I think it's almost like 3 million, and then You have to, I mean, with everything going digital, I think Domino's is set to keep doing good. I mean, they have good technology, they have good brand recognition, like you said. I mean, they're probably going to be able to pull off their own fleet. So, and then the third option, like you said, it would be to start your own pizza place. But I just think it's so costly, and in a restaurant, I just think you have to have advantages. And
Mhm.
if I went into the pizza, I mean, I just think people don't go to eat pizza to be fancy. They just go to just have a quick bite of something they like, or just get it to their house.
Right.
If I went on my own, I'd probably go into maybe a steakhouse where
Mhm.
maybe you can just charge higher prices, and by you being there is going to make a difference. I don't think in a pizza place with that will happen, just because
Mhm.
it's a different type of experience.
Yeah,
But
it's
that is my view.
like a fast, sort of like fast food in a way. Like it's in a different segment. But yeah, like
Yeah.
it's very interesting thinking about, restaurant models and how, Domino's, like you said, beat out Pizza Hut. Right now it's at the top of the pizza lists, and Papa John's had some controversy. So there were, a lot of the moat that Domino's has built has been strengthened in recent years. And I know they had somewhat of like a slight rebranding. Like I noticed like some of the Domino's, like they took away pizza and they just leave Domino's because they're also trying to appeal like with more food options, right? Like salad or whatever, something else that is also in addition to pizza.
Yeah, I 100% agree with you. Now that you say that, it reminds me that I used to love Buffalo Wild Wings,
Mm.
but with Domino's having, I mean, I love the Domino wings. So, I mean, now it's just easier and cheaper to get Domino's. So I just left Buffalo Wild Wings.
You get wings from Domino's instead of Buffalo Wild Wings.
Yeah, just because, I mean, they are everywhere. So it's just much easier to just go and grab it. I mean, I do like to go pick my own food. I usually don't get much that delivery. I go and carry out.
Yeah.
So it's just better quality, I feel like it.
Hmm.
And Domino's is everywhere. So I mean, and the quality of their wings, I think they're great too. So yeah.
And do you think, if the economy might struggle, do you think that Domino's is recession proof? Like people will still keep buying Domino's no matter what, even if they lose their job or, something happens in the economy where people have a hard time.
Yeah, I definitely think so, because their quality and the price they offer is at a really good point. So I definitely think, I mean, people that maybe will go to higher price restaurants are just going to pull down to Domino's, and the people that used to go to Domino's when the economy was is great. I mean, they still will still go. So I just think it is recession proof. That is my point of view. Yes.
Well, and do you think there's a good potential buying opportunity of the stock then when, let's say, with interest rates staying higher up, and if they need to refinance, they might come across some quarters where they might struggle a little bit, and then institutional investors on Wall Street maybe might sell off the stock because they're like, oh, they're underperforming and they're having less earnings because they have to pay more on interest and debt payments, right? So, do you think that that might be a good potential time to look at where the stock could be trading if it's at an even bigger discount maybe to its intrinsic value?
I definitely think it's a good time to look into it, because, for example, at the end of the 2021, the stock was like 550, and now is almost 300. So I do think it's a good time to look into it. I mean, the stock, I think the whole company is worth like 11 billion, and you're making 500 million, but I think that we still owe 5 billion. But I
Mhm.
think it is a good point, at least to take a look, if you think you can understand the company and you are
Mhm.
interested. I think it's definitely one of those restaurants out there that if you like the business, you should look into it.
Yeah, and it looks like it will continue growing as it's still been, even during the pandemic, like it still added more stores. Like like you said, like 3,000 in the last few years. So it was very impressive because you would think they're already everywhere, right? But they're still able to keep growing no matter what. So that's nice to see.
Yeah, I totally agree. I mean, I think they are going with the world because everybody just wants to these days. I mean, with work from home, I mean, many people will just like to go pick up or maybe get delivery, and they are really good at that. I mean, they offer a really good product at a really good price. So I definitely think you're right.
Well, it's awesome. Well, did you have any closing thoughts you also wanted to share, Alejandro? Because this has been awesome to learn more about Domino's and their financial performance and, a very helpful debt lesson that we can all keep in mind.
No, I just want to thank you again for giving me the opportunity to be here. I really think your work is really good, what you do for your audience, and thanks again. I mean, it's been a pleasure.
All right. Thank you so much, Alejandro. And until next time, we look forward to talking with you more about future analyses of companies that we think would be very important to help people grow as investors. So thanks again. Until next time.